Good afternoon, everybody. You may have guessed, I am actually not Tim O'Reilly. I'm sorry. He got called out of town on business, and I'm going to do my very best Tim O'Reilly impression. Welcome to Code for America. Some of you have been here before. If not, you should know that we call ourselves a Peace Corps for Geeks, and we're a bunch of people who care about fixing government and about innovation. And so I think it's very appropriate that we have a guest here today that we're excited about, Bill Janeway. And Bill has written a new book, but he's also been sort of a guru for a number of people following this idea of the innovation economy and what it might mean. We're, of course, particularly interested here in how the state is an actor in this game, and we'll draw that out. But I just wanted to welcome Bill.
Thank you.
And if we could just get started, I think the benefit of having me instead of Tim, by the way, is that I am much less schooled on these topics. So I'll bring the conversation down to a level that is accessible for everybody here. But I thought it would be good to start by just having you talk a little bit about certainly the sort of key concept in the book, but I also, the book is really written as your story. And if you could just give everybody here a little bit of sense of your background coming out of academia and Wall Street.
Sure. Delighted to, Jen. It's wonderful to be here. I myself have not visited Code for America except virtually, and it is a terrific mission and project, and I'm really very, very pleased to be here. And while Tim is not only here in spirit, much more importantly, he's here in print. If you hold up the book in front of you and look at the front cover, you will see that the contribution Tim made to this book is absolutely outstanding and highly visible.
Shall I read the quote?
Sure.
Wise, insightful, and rich with both economic history and the personal stories of a brilliant investor.
Right! So the first half of the book, in fact, is what you English majors will know as a Bildungsroman. It's how I learned how the innovation economy works. Having left academia, Cambridge University, where I did my doctorate in 1970, and where I had been so immersed in the economics of Keynes, for you guys who vaguely remember Eco 101, that I found it impossible, temperamentally and intellectually, to teach Keynesian economics. So I stumbled into Wall Street by not quite chance into a firm which was very distinctive in old Wall Street, where there were lots and lots of private partnerships, all subsidized by the New York Stock Exchange monopoly. This one was exclusively focused on the science-based industries, from chemicals in the 30s to pharmaceuticals in the 40s, electronics, and then on to computing by the time I got there in the early 1970s. And I got immersed in, most particularly in computing in the mid-late 70s, and evolved and helped the firm evolve from playing the role of an agent advising emerging companies and bringing capital to them into a principal, into a venture capitalist. Along the way, I guess I have to say, pleasantly surprised to discover how much of the economics I'd learned at Cambridge was relevant. And in a nutshell, three things. One, Keynes's economics was all about uncertainty, all the way down. The notion of rational expectations and Keynes's economics completely at odds with each other. Second, finance and economics always together. Every financial decision has economic context and consequences. Every economic commitment, every investment is not merely an investment in real productivity. It is in the context of how the financial markets are valuing physical assets and virtual assets. And then finally, the integration of that around the notion of a set of markets of financial capitalists and a government that are always engaged with each other, always engaged. And what happens in the market doesn't stay in the market if it really matters. And on the other hand, a government with a legitimate political mission can play an extraordinary role in driving the market economy forward and equipping it with the tools. So as a venture capitalist, I guess I'd say I learned two things. One, the hard way, and the other with extreme delight. What I learned the hard way is that operating under conditions of uncertainty, bad things happen. By definition, they're not anticipated. CEOs blow up on you. You plug something in and it doesn't light up. The big ugly who was supposed to be paralyzed by innovator's dilemma wakes up and comes at you and does all sorts of really bad things to the marketplace. In that context, there is one hedge against uncertainty, and this is really the theme of the first half of the book. It's what I call cash and control. Unequivocal access, there you go, to enough cash to buy the time to find out what the hell is going on, and enough control of the situation to shift the parameters of the problem, to be able to take a project and say, you know what, we're going to get this off the street before it becomes a tired body, or we're going to recapitalize it, or we're going to bring in new leadership, et cetera, et cetera. So that is a lesson which I then realized scales all the way up. So if you think about all of the great tech companies today, from the last generation Microsoft to the current generation Google, for economists, they operate with such vast amounts of excess cash. Well, why do they do that? Well, we all remember, Apple almost went out of business. Oracle 20 years ago was 10 days from not making payroll. Sun, before it had its rebirth, again, practically went bust. When you're signed up to take maximum technological and market risk, why would you take any financial risk at all? And then at an even larger scale, in 2006-07, around JP Morgan, there was this phrase, we're going to build a fortress balance sheet. And that's what Jamie Dimon did. He did it by shifting the terms of trade against his counterparty, put Bear Stearns out of business, and then bought him cheap in doing that. But he wound up as the one global bank in the world that was actually going to survive without a government bailout in 2008. And then you can take it even further, up to China. After the Asian flu of the late 90s, when the IMF hammered all of the economies into the ground in the name of the Washington consensus, they all set about, China being the biggest, to accumulate enough cash, in China's case, $3 trillion of reserves, so nobody else would ever tell them again what they had to do politically. So they'd never be in the position of a Greece or a Spain or an Ireland. So that notion of cash and control is something I think is very, very fundamental. The second thing I learned, and this goes back to getting involved with computing, is that through the 80s and 90s, right through into the bubble, all of us, the venture guys and the entrepreneurs we were backing, were dancing on a platform that had been constructed for us by the federal government, and very specifically by the Department of Defense, by many different agencies of the Department of Defense. It was the platform of 25 years of massive investment in the upstream science and technology that enabled the digital revolution. And then secondarily, the NIH, beginning in the 70s, pouring money in to create the possibility of a biotech industry. Taking that seriously is one of the two major themes of the second half of the book. And that absent that, as demonstrated by the failed aspirations of those investing 10 years ago in nanotech or 10 days ago in clean tech, venture guys can't fund science. The time horizon, the only place where that has ever worked is biotech. It's a special exception. There are 2 pages in chapter 4 on my take on the biotech exception, which I'm happy to go into, though I don't think that's the primary interest of those here. So that's one. But the second is the role of financial speculation, the role of bubbles. So I spent a dozen years from the late 80s through into 2000 building a portfolio of companies that were dedicated to assisting IBM from becoming the environment in which all commercial computing took place, which it still was in the mid-late 1980s, to being just another competitor. And I think collectively, a lot of us, a lot of companies still around like Cisco, et cetera, and Oracle, did that. And in 1998, we discovered we were being valued at prices that were bizarre, that could be observed previously. There's a nice little chart in there which shows the moment of realization for us at Warburg Pincus when our two great companies, Veritas Software and BEA Systems, when you took their stock charts and you put them against RCA in 1929, they were identical. So my personal story of this is we took my entire portfolio and gave it to the market and our returns to our limited partners between 98 and 2000. And therefore we were able to raise another big fund in 2002. But that role, the role of financial speculation, like the role of the state, can be tracked all the way back through the history of the innovation economy, back to even before industrialization. And one of the sort of major messages of the book is that financial bubbles are banal. Wherever you have a liquid market in any asset, from tulip bulbs to mortgages to the debt of emerging nations, and occasionally to securities that represent participation in a fundamental new technology, from the railroads to the internet by way of electrification and the automobile and aviation, you will have a bubble. And this is why it's very dangerous to say no more bubbles, let's stomp them out. When bubbles infect the credit system, and when the object of speculation has no prospect of radically increasing productivity, when it gets into the banking system, there's a role for the regulators in chopping it down. But you all remember back in the late 90s when my friend John Doerr was talking about the $6 trillion increase in the largest legal increase in wealth in the history of capitalism. Well, in 18 months we lost that $6 trillion and the world didn't end. So equity bubbles that are limited to the equity market and then focus on technology, I'm not saying they should necessarily be encouraged because it's very hard to generate them, but when they get going, there should be a greater degree of toleration for them. So one of the big themes in the second half of the book is tolerating waste, and why efficiency, the aggressive pursuit of efficiency which is the core virtue and value of mainstream neoclassical economics, is the enemy of innovation. That on the long-term supply side, the Schumpeterian side of the economy, tolerating waste, tolerating necessary waste, is a good thing. On the other hand, and this is, shut up and invite questions. On the other hand, taking me all the way back to Keynes' students whom I studied under at Cambridge more than 40 years ago, there's another kind of waste which pursuit of efficiency tolerates, and that is very bad. And that is the waste of unused resources, where skills atrophy, machines rust, factories fall down, funding of R&D, funding of new investment is cut back. There's a thin but important line of academic research that recognizes how persistent unemployment on the demand side feeds back to reduce the potential for growth on the supply side. And that's why the interaction of the pursuit of efficiency, which on the one hand has the federal government with this appalling program called STAR Metrics. And believe it or not, STAR Metrics is an acronym.
11 letters.
Science and Technology for America's Reinvention.
I'll get it.
Measuring economic, it goes on and on and on. But the notion is that the NSF and the NIH is supposed to evaluate every investment and research that they make in terms of its impact, its measurable impact on employment. Insane. Would we have been funding number theory 55 years ago, knowing it was going to produce Google, right? Or cryptography that enables Amazon? The other side of it is that the demand for efficiency is what says that there are that every initiative of government should be evaluated as if it were being made by a business person, even with unemployed resources. And that is what can freeze us into this period of the stalling of the innovation economy. And it's also why historically, merely talking about market failure isn't enough. The need is for politically legitimate missions. Once upon a time, it was national development. We subsidized the construction of the transcontinental railroads to tie California to the north in the Civil War. And similarly, of course, across Europe. Then it became national security. A third non-economic political mission, conquering disease, was legitimized in the 50s and 60s and underwrote the massive investment in the NIH. So today is a period of frustration. We know that the stall out in Washington, I guess I'm in an audience where I can say that breaking out of this, we may be seeing one of the critical factors necessary, namely the Taliban losing its grip on the Republican Party day by day. I've been saying that we don't need a Sputnik moment, we need a Pearl Harbor moment. The good news is we know what that'll be when we lose the Greenland ice cap and Palm Beach is under 2 meters of water and the Koch brothers are in Washington demanding federal action. The bad news is that's 60 years away at least. Maybe we can get to there, but reinventing, rediscovering government as a legitimate economic actor is essential to this. And I'll close by saying that the guy who hired me at Warburg Pincus 24 years ago used to say, you can't survive as a venture capitalist and be a pessimist. And my optimism is actually focused on the one unequivocally positive consequence of the global financial crisis of 2008 and the Great Recession that followed. And that is that it has really shaken up the academic disciplines. Finance and economics are re-engaged with each other. They both have had the residual faith in efficient and complete markets and rational expectations radically undermined. And as a measure of that, before 2008, it would have been unthinkable that the main core economics faculties at Princeton and Cambridge would have invited me to teach. Absolutely unthinkable. So take that as an index.
That's your optimism?
Good stuff.
Great.
Good stuff happening. But it will define the conversation a generation from now.
Okay.
The way that the market fundamentalists defined the conversation in the 1980s.
Great. Yeah. Well, I'm glad to have the optimism. There's also a fair amount of pessimism in here, and I want to draw that out. I just want to bring it back a little bit, just sort of get some of the fundamentals out. And by the way, I feel the need to say Code for America is a nonpartisan, non-political organization. Whatever I may personally agree or disagree with Bill on, I put that on the record. Can you just start by defining the innovation economy as it is distinct from traditional understandings of economics?
Sure. Well, as I say, think of it as three stages in a process that is self-referential, reciprocal, feeds back on itself, lots of loops. Upstream, scientific discovery, technological invention. Downstream, the exploration of new economic space that is created when sufficiently significant technologies are deployed as networks, from the canals to the railroads, the electricity grid, the highway system, the internet. Now, upstream, trial and error and error and error. Downstream, trial and error and error and error. Midstream, when you start building a network, by definition, it is impossible to know what its economic value will be until you know how it's going to be used, and for what purposes, and by how many. So, at every stage of the innovation economy, process is fundamentally dependent on sources of funding that are decoupled from a narrow focus on economic return, on return on investment. That's why upstream science was funded by philanthropists. Darwin's grandfather and father were both extremely successful angel investors. The first physics laboratory in the English-speaking world at Cambridge, the Cavendish, was named that, not because the natural scientists at Cambridge all got together to build a monument to the 7th Duke of Devonshire, William Cavendish. The money came the other way. There was a period from the roughly 1900 to roughly 1970 when the great corporations devoted a portion of their monopoly rents to funding fundamental science as they came under competitive pressure from AT&T to IBM and back again. The focus came to be completely on short-term applied research. But by then, thanks more than anything else to the Cold War and a set of political entrepreneurs, the federal government had been mobilized as a legitimate aspect of its role was to fund fundamental research. So that's one side. On the downstream side, there's never been any substitute for speculation. To get an Amazon or an eBay, you need 100 pets.com. And that was true in the automobile industry. It's been true throughout.
And is that the Schumpeterian waste, or is that the...
Schumpeterian waste all along the supply side.
Okay.
All along the supply side. And then in the middle, you have examples of transformational networks that have been entirely funded in the private sector. The British railway system was that way. You have, on the other side, the interstate highway system, entirely funded in the public sector. In each case, when you look down from 40,000 feet and see that 4-lane highway crossing the wasteland of Wyoming, or you realize that in 1845, the British had already built 21 different ways to go from London to Brighton. Efficiency is not what it's about, right? Whether it's private or public sector, those networks only get built either by a national mission or by speculation. So that is, I think, and that challenges the central doctrines of neoclassical economics. And that's why I think of the innovation economy as distinct from, distinguishable from, and in fact, orthogonal to the notion of the process, even as formalized in, quote, new growth theory, where it's all about, to use the technical term, the intertemporal optimal allocation of resources. Well, how in the name of Keynes do you optimize resources intertemporally when you're talking about 10, 20-year time frames, right? And half of the commodities that you're supposed to be devoting your budget to in a rational way haven't been invented yet, right? So it's irrelevant. And that's why I think of the innovation economy as its own distinct entity.
And so you're talking a lot about sort of the mistakes that we're making right now. Is it essentially from misunderstanding the dynamics of the innovation economy, or is it just sort of the political environment that we're in?
Well, I think it's both, and I think they fed on each other. So on the one hand, there clearly is a substantial faction which has been empowered intellectually and legally, Citizens United, whose mission is to render the federal government, any state, illegitimate as an economic actor, and to the Grover Norquist movement. As I say, they may be, fortunately, running out of steam. But there's also this intellectual heritage that goes back to the 70s and became instantiated at places like Chicago, et cetera, where the markets are efficient, government is inefficient, QED, right?
So reducing it.
Right, and that's why rediscovering this history of how the inefficient processes of state investment led us through 5 successive waves of technological revolution that took our living standards and the productivity of economic activity from where they were in 1750 to where they are today, why that is so important.
Right. And so where are we doing it right now in terms of, is there innovation, is there investment in innovation and research right now that does give you hope?
Well, I think we have, in effect, we have some, there's an ongoing, the NSF continues to fund fundamental science, it's at a very narrow level. I think we've made some mistakes. I think the Department of Energy, in picking up the Bush administration's program of loan guarantees for new energy initiatives, made a fundamental error. And it was absolutely contradicts what was done successfully by the Defense Department, because in providing big loan guarantees, this is not answering your question, saying this is where we're still doing it wrong, or doing it wrong in a different way. I really think this is a tragedy. The Solyndra and Tesla and the A123 loan guarantees just start to want to be winners at the frontier of the commercialization of immature technologies, is the exact opposite of what Defense Department did in the 60s, when instead it would put out a spec and say, if you can meet this spec, we'll buy some of your stuff and we'll test the hell out of it. And if it works, we'll buy some more and we'll see if it's reliable and we'll bring you down the learning curve. Oh, and by the way, in return for being a creative and supportive customer, we're going to require that you share the intellectual property. You're going to have to license the patents if you have patents. No patents for software, of course. And if what you're doing is really important to us, we're going to require that you put a second source into business in case you screw up and fall over. So that created a commons of innovative intellectual property that enabled this enormous acceleration from silicon to software from roughly 1960 to 1980. Yeah. That's the platform. So I don't see us doing that now. Frankly, I don't see us doing that anywhere.
We're doing some of this now with this new challenges focus of the federal government, but it doesn't seem like it's got the rest of the pieces there to work in that system.
You need scale, because again, a lot of the stuff is going to fail. I mean, for example, if you think of these poor guys at A123 out of MIT, they went through $800 million, absolutely pushing the limits of what you can do with lithium-ion technology for batteries. There is so much upstream science that is yet to be done and has to be done at scale in lots and lots and lots of labs to do all that kind of research funding, but then have a continuing procurement program. And if you can deliver a battery with this energy density, we'll put it in 100 Army trucks and drive it around the Mojave Desert for 6 months and see if they still work when we plug them in. And then we'll buy 1,000, and then we'll buy 10,000, and then we've got a new industry. That's the kind of initiative I would love to see.
How do you see open government data in that context? Is that something we're putting some investment into? First of all, I think more transparency, and also I think the kind of work that is also decentralizing demand for innovation. So smart cities initiatives, some of the stuff we're beginning to do around New York, we've had some little issues there, some really classic programs of mishandled and mismanaged. Right. But I think the one area, here's where I think we are doing it right, in healthcare. I'm trying to remember the term, the meaningful use of technology in the delivery of healthcare. That initiative, which has now been amplified under the Affordable Care Act, I think is making a real difference, and is an area where advanced information technology can make a profound difference, both to costs and outcomes. And it's just beginning now to be deployed at scale. I wanted to circle back, make sure we get some of the fundamental pieces, out there. Can you just define for you that you talk in the book about the three-party game? So I think it really helps solidify the core ideas in the book.
Well, this goes back to what I said about what happens in the market doesn't stay in the market. So think about the environment in which we exist as consumers, producers, creators, citizens, as a kind of arena in which there are three players whose scope and role interacts with each other, overlaps, feeds back. Think of the market economy where people go to work, earn income, spend some of the income on goods to consume and services to consume, save some of it, as a world of relative continuity, regularity, predictability. Okay? Then recognize that all those people in the market economy today and for the last roughly 100 years are also participants in political process, in the state, in some way having access to or a call on the state, especially when they lose in the market economy. And even when you have a restricted franchise, the most important economic policies of the American government for its first 120 years, the protective tariff, in response to the demands from the nascent manufacturers looking for protection against the Brits, who were far more productive, couldn't compete in the marketplace. So you have a process through which the marketplace and the political process are competing domains in which to fight over the distribution of income and wealth and the allocation of resources. Third, and independent from both of the first two, are people like me, financial capitalists. We've been around ever since there was enough of a surplus. You can read all about us in Fernand Braudel's fabulous 3-volume history of pre-industrial capitalism that he wrote 30 years ago. Financial capitalists exist and thrive and prosper by exploiting discontinuities in the market process, often, not always, driven by innovation, and discontinuities in the political process. And that is what I call the three-player game. And appreciating that is a way of recognizing why there's sort of nothing new in the notion that you would have, the federal government building this platform for people like us, for venture capitalists and entrepreneurs, and on the other hand, financial speculators rewarding us absurdly, excessively, for getting it right with respect to this major discontinuity in the market economy created by IT. Right? So that's a sort of inframing theme of the whole book.
And so just to stay on that for a second, one more question, sort of, again, back to the state. We had Daniel Suarez here to give a talk a couple months ago, and he is really, I think, bringing out this notion that the state is weaker and weaker, and that the sort of, we really need to, it really makes you think about sort of protecting that one party in this game here.
Yeah.
How should we talk here at Code for America a lot about the notion of our identities as consumers and identities as citizens.
Right.
So how should we be thinking about our identity as citizens as it relates to the state in this political environment, but separate from that too, assuming that the political environment is going to change?
Well, I think we can take some real comfort and even joy in recognizing that this wave of highly funded effort to delegitimize the state, it crested. It really seems to have crested and to be retreated.
Do you mean like last week, or?
I mean, on November 6th.
Okay.
Yeah.
Okay.
Yeah. By the way, I think that's one reason why the Romney camp and the Republican establishment around it were so stunned. They thought it was done. They really believed that it was done. So that was a function of a lot of different things coming together. It was a function of a lot of people believing that they had a stake in an open and responsive political process, and that it wasn't all, hadn't all been bought and paid for. And that, yes, politics is messy, but, so's everything else. So's everything else. So I'm beginning to feel that we can work our way back. Now, the process well, let me put it this way. Here's grounds for optimism about the liberation of the state to be able for it to be a competent actor. It is only 12 years ago, the existential threat that the American government posed to the global financial system was that we were going to eliminate the risk-free asset by repaying the entire national debt, right? At the end of the Clinton administration. Remember the $1 trillion surplus. It took 2 wars of choice, funded by massive tax cuts, right, to put us into this position today. It doesn't take a hell of a lot of collaboration. There wasn't that much between Clinton and the Republicans in in his second term to refound the financial base on an adequate basis. And as Paul Krugman keeps saying, the bond market vigilantes are happily buying all the treasury paper they can get for a negative return. So there's ample time and space not to get panicked into a destructive response to the irresponsibility of the Bush administration. So I think there's ground and reason that we can work our way out of this. It will take, and I do think that finding these particular, in a sense, demonstration opportunities, and there should be more around the post-Hurricane Sandy response, for where a responsive government that is listening and is open and transparent can gain credibility before we get to, oh my God, Pearl Harbor, and we have no choice.
Can you talked earlier about bubbles and the role of the state in sort of rescuing financial capital.
Right.
So what's the next bubble? I know it's an unfair question.
And again,
how should we be thinking about that, especially in our sort of fragile economic state?
So I'll go back and sort of extend a little bit what I said before. As I said, first, bubbles are banal. Wherever there's a liquid financial market, a liquid market in any asset, it may not be financial. Tulip bulbs weren't financial, although they had derivatives written on them, by the way. There will be a bubble. And investors always have to be asking themselves, how long can I afford to be wrong? Because if you're wrong long enough, they're going to take away the money that you have to invest, right? And consequently, herding behavior is endemic to the financial markets. And the more mature they are, the more they're intermediated, the more there are professional money managers, the greater the propensity for herding behavior. So there will be bubbles. There will be blood, there will be bubbles. Second.
The new movie by the Coen brothers.
Right. But second, it really matters. Think of a little two-dimensional matrix. Along here is the locus. Is it only in the stock market, or is it spilled over into the credit system? Into the banking and even the shadow banking system. And second, what's the object? Is it productivity enhancing, or is it beach houses in the Nevada desert? And to the extent that it's infecting the credit system and the object is clearly non-productivity enhancing, the Federal Reserve can take away the punch bowl. Just as a former chairman, a pre-Bernanke, pre-Greenspan chairman used to say, that the job of the Federal Reserve is to take away the punch bowl when the party really gets going. And it always has the ability to do that. Where will the next one be? It ought to be clean tech, green tech. It ought to be. It's, on the one hand, the process of deleveraging, which took place very rapidly in the corporate world, In the household part of the economy, we went from negative savings, 3% dis-savings, to 7% savings rate. That's why you have, and that's why, by the way, if you hadn't had the federal government going into massive deficit to offset that, we would have had 20% unemployment. We would have been back in the world of the 30s. So the challenge, I think, which is a question you haven't yet asked, the challenge is, as you began by saying, Jen, this financial crisis inducing the state, the Treasury, and the central bank to save the bankers from themselves in order to protect the market economy is a classic example of the three-player game in action. But in doing this, it projected us into a new world. Despite everything you've been told, this time is different. In 1933, 31, 32, 33, federal government stood by. The banking system collapsed. We had 25 to 30% unemployment. Now, with 30%, 25% unemployment, you get Glass-Steagall. With a lousy 10% unemployment, you only get Dodd-Frank. But think about it.
The recipe.
The radical, so you have to be careful. You say, I really want Glass-Steagall. Are you implicitly hoping for 25% unemployment? No. But
you should define Glass-Steagall just for the non-AA.
Oh, Glass-Steagall was separate investment banking from commercial banking. It was one of the regulatory responses, along with deposit insurance, to the catastrophe of 1932-33, when we did have the official number is 25% unemployment. Nobody will ever know how much unemployment there was. It was talk about open data. Right. The data wasn't there to be open. Today, we have this ongoing, what I think of as, in the corporate world, in the investment world, this is what we call a workout. It's better than a liquidation, but it's painful and it's slow. And while it's going on, we should not expect another bubble. Mm-hmm. We can see, little micro, this silliness that was capped by the Facebook IPO. Mm-hmm. It was kind of limited in scale and scope, and clearly with Zynga and Groupon down 80%, it's over. We should not expect another bubble. But when we get one, what we need it to be is focused on clean tech, green tech. But we have, as I say, we have to build that platform. It hasn't been built yet, and it's not going to be built by venture capitalists.
Looking forward to that bubble. I have one more question, and then I'd like to open it up to the audience. And this is sort of maybe a big one too. You're based in New York, spent significant time in Princeton and London, and you're out here in Silicon Valley, and your investment philosophy is relatively different.
Yes.
I'm going to read the investment strategy of Warburg Pincus. Bringing active but patient equity capital back to exceptional operating executives in order to build or rebuild significant and sustainable businesses. So can you just contrast your investment philosophy with what you see out here and take that at the further step and just what would you ask the people who are sort of immersed in this culture to think about that you have to offer?
Okay. So I started coming out here in the late 70s, by the way, and then I by 1980 I was into a kind of practice that I was out here somewhere between San Jose and San Rafael 7 to 10 days a month, every month, as we build, and then when I joined Warburg Pincus, the question was, should we have an office out here? And I decided I didn't want to have an office out here. You remember Butch Cassidy and the Sundance Kid? Okay. You remember when they're up on the bluff, they're on the run, and they look back across this endless plain, there's this little cloud of dust. And I think it's Sundance says to Butch, who are those guys? Yeah. I always wanted to be those guys. What I saw was that, and I grew up professionally in the 70s when there was no IPO market. Mm-hmm. To build a business, you had to get to positive cash flow from operations. In fact, the guy who is, there's a guy who I refer to as a mentor in the book, very complicated and somewhat controversial guy, who used to have pillows made up, throw pillows, which he'd give people, he'd give his entrepreneurs, said corporate happiness is positive cash flow. So that was really embedded in my way of thinking already by the early 1980s. And what I saw out here, and what I originally saw at Route 128, was that the canonical venture model was to find to identify where there was a technological opportunity to introduce a new product or service increasingly, to back a project and to fund it in a series of rounds where the first round, we used to say, you plug it in, does it light up? Yes. We do a second round and we say, do we have 2 customers, 3 customers who will raise their hands and say, I paid real money for this, it works, I'll buy more. Then we do another round. And you hope that the project becomes a product and the product gets enough legs to begin to become a business. And oh, by the way, beginning in 1982, you can assume that once you get to that stage, you can start thinking about an IPO. The typical IPO in the 1980s was $10 million in total capital raised. In those dollars, 20, 25 million today. It was for a company that had revenues of 20 to 30 million, say 40 to 50 million today. And that was the default option. Now, I was sufficiently scarred that what I want to do is the other way around. So let's start with markets. Let's start with markets and look for potential discontinuities in those markets. And then let's work our way back to what are the components of a business that can exploit that discontinuity. And this went with a notion that of all those projects, plus all those companies that were looking at new technology but were scared of cannibalizing themselves, et cetera, one of the mantras I evolved by the mid-'80s was there's always more technology than anybody knows what to do with. The scarce resource, the really scarce resource, are entrepreneurial executives who have built or set about building businesses to address new market opportunities. And if you can connect with those guys, and you have, and this is why joining Warburg Pincus worked out to being very essential, that you need to have capital. And that's why we developed a model for investing that we began with in the early 1990s. And Warburg Pincus has now deployed this from IT to medical devices, and enormously in the world of energy, what we call line of equity financing. It's the opposite of the standard venture model. Sit down with the entrepreneur, your entrepreneurial partners at day one. Now, it really helps if they've been through a failed startup or a near-death experience in a real company, because then they appreciate what access to capital means, right? And at that point, you do a rule of thumb, a heuristic on what do we need to get to positive cash flow, knowing that from day one, we're probably going to be buying stuff as well as building stuff. In the case of what became half of Veritas Software, it was 25 million. That was a lot of money in 92. BEA was 50 million. My energy partners have done lines of equity at 400 million. You price that out up front. If you take it all down, you, the founders, will own X, will own Y, will both be diluted by the talent that comes on board or that we acquire, and you set about building the business. Bingo. The stuff that I did that really worked could never have been done in a standard venture capital model. Now, I'm a little surprised, I have to say, given the bifurcation of the venture capital world between the, let's say, the seed, alpha, A-round oriented players. And that, by the way, really works in anything to do with where, offering a new service on the internet with open source tools. It's really cheap. You can really get something going very quickly. But on the other hand, the guys who are now running billion-dollar-plus funds, why they haven't sort of rediscovered that line of equity approach. Mm-hmm. It does still seem to be very antithetical to the model out here. Mm-hmm. So I'm not recommending you all that you all start. By the way, it's very hard. It's very challenging because you're not going to be, you're going to have to be second guessing yourself all the way through, mm-hmm. because you're not going to be doing a market test on whether you can bring third-party money in at a higher valuation. But when it works, it's spectacular, and there's no other way to do that kind of investing.
Well, you're going down to Andreesen Horowitz after this, and you'll say the same thing there, and there'll be a big wave of it here.
Marc and Ben know very well. Yeah. And they both, and Marc's on the book too, so they know the model. He's
on the back cut, and Tim's on the front.
Well, so. There you are. I will say that as long as there is what I guess technically you'd call pigeon follow-on money from firms that have capital and no deal flow, doing it in the standard model is pretty easy. Pretty easy. Yeah. And my model only works, as I say, where you really have entrepreneurial partners, with scars all over their bodies, right. and help, and with luck you've been in the trenches with before.
Okay. So I'll sum up, and we'll take questions. Scars are good, bubbles are good, government is good, equity bubbles are good.
Government can be good.
Government can be good, and there's some reason for hope. Yeah.
Yeah. There you go.
Okay. Yes.
So you said that it's going to be a while before, I'm summarizing you, the tide starts lapping at the feet of people who can actually change policy. But didn't the Hurricane Sandy kind of have that?
No. I'm saying that the tide of the market fundamentalism, government is bad, government is all bad, that crested and is retreating, thanks in part. It's a bad metaphor on my part.
All right.
So I think that that November 6th, 2012, and I guess November 1st, October 31st, 2012, may represent turning points.
Mm-hmm. So you're accepting acts of God then?
Well, let me put it this way. This came to me as I was running the second day after Hurricane Sandy hit. Who'd have thought that the Lord God Almighty would have chosen this instrument through which to communicate which side in this election she was on, and that she would have chosen Chris Christie as her messenger.
There you go. We got one in the back. What do you do next, Bob?
Bill Clinton was responsible for the repeal of Glass-Steagall.
Correct.
At the end of his administration. But my question is, Lincoln's Taliban love child, the GOP, continuously rails about regulation. And that was, I liked your thesis, but it somehow was absent from a lot of your discussion. Can you just discuss a little bit about how, in their words, hegemonic regulation affects capitalism and innovation, particularly in the energy sector?
Okay. With respect to the regulatory issues, often and generally, the regulation has come through a political process that begins by responding to genuinely, how should we put it, rent-seeking behavior on the part of people in the market economy, and often winds up being legitimized by competitors who are saying, we need an FDA to protect us from these bastards in Massachusetts who are doing the compounding on the side, so that you get a kind of good guy aspect. Now, there's no question that it is possible, and you never want to say that government can't be criticized. If you wanted to try to open a business in Italy legally today, even before you start talking about the bribes you have to pay to get through the regulatory process to be in business or to be certified as a massage therapist, it's appalling. So there certainly can be overreaching regulation, certainly. The area that I'm most concerned with and most interested in, and frankly, far and away most knowledgeable about, is the financial world and financial regulation. One of the dedicatees of the book is a fellow called Chaim Minsky, who was really the most creative of the post-Keynesian economists. And Minsky wrote a book back in 85, 86 that very much anticipated what's happened today. Has one of the worst titles imaginable that a book could have, Stabilizing an Unstable Economy. Really makes you want to run out and grab it. But he talks about the new world of big government capitalism that we've entered in on, where for the first time, the government, both in its borrowing and spending and in its central bank regulating role, has the ability to save bankers from themselves, as they inevitably will produce a catastrophe. And he said, in doing that, they will legitimize the behavior that created the catastrophe. So it only can work if, having saved the bankers, it renders illegal the practices that got us there. Well, that's the struggle, obviously, we're in right now. Where we're coming out, it seems to me, is more likely that we're going to just make banking a lot less profitable by requiring that a lot higher reserves be held without directly addressing as much as beyond the Boca rule. There'll be more regulatory response in Europe than in the United States, particularly in Britain. But I think that the regulatory role, I do see it as, again, embedded in this game, where those who are losing in the market because John D. Rockefeller's father, William Rockefeller, was selling snake oil, which is how he made his living. Yeah, literally. He was a snake oil salesman. Literally, he was a snake oil salesman. He was a snake oil salesman in the Midwest in the 1850s. And the FDA gets created to respond to that. I think that there will always be cycles and there will be excessive regulation in some instances and inadequate regulation in others. I think it's inevitable.
We had Nate and then Bob.
Yeah.
Sorry, Nate.
So I'm not really sure if it's possible to have a financial bubble without infecting the credit system, but because any perceived asset you can expect that it's going to be used as collateral. But I agree with you that not all bubbles are the same, and that sometimes they can be good. My friend used to say that the most beautiful flowers only bloom after the flood. Yeah. So I generally agree with that. But I think another way there's so many things I can talk about, but I guess I can try and limit it to ways to sort of improve this problem. And so one way of maybe paraphrasing your thesis seems to me like the private sector always underinvests in technology, which is basically an economic truism. Everyone knows that. So how would you feel about the government giving matching funds to VCs, or rather to the companies that VCs are investing in, or and the worst bubble of all is a land value bubble, and it's predictable. It happens every 15 or 20 years. So when the financial sector invests in land, it's not really investing in anything that is productive. It just creates a monopoly. So you could take back the rents for those and apply it to things that.
You've got a bunch of different things there. So let me try to pick out at least 2 or 3 things I could respond to. One, you're absolutely right. One of the classic examples of market failure, originally written up by Ken Arrow and Dick Nelson in the circa 1960, 50 years ago, is that the private sector in a competitive economy will not invest in enough in R&D. However, the problem, investing in R&D is different from giving money to venture capitalists. The problem is that upstream investment, state investment in R&D, to compensate for inadequate investment in R&D in the private sector, gives you the NSF. That's what the NSF's mission is. That's what its validation is. It doesn't give you the DoD's investment of a decimal order of magnitude more in creating the digital economy. That takes a mission that transcends economics, that gains broad political support. I think as and when we get the kind of investment needed for creating the platform for the low carbon economy, it will take that kind of mission. Oh my God, we're getting a Hurricane Sandy, every year. Second, there is an existence proof of government subsidizing venture capitalists that worked. It's called Israel. The government did create a fund which took a capped return in the first round, created a fund of funds for venture guys, and the fund of funds allowed its return to be capped so that the venture guys, in effect, had a leveraged play. I don't think that makes any sense in the United States today. First of all, I don't think there's a shortage of venture capital. Arguably, we continue to be in excess supply. From 1995 to 2000, the amount of money going into venture capital per year went from 5 to 8 billion a year to 105 billion. That was the herd-following behavior of the state pension funds that got the message just in time to pour the money in at the top of the bubble. The amount of money managed by members of the NVCA went from 25 billion vintage 1995-6 to 225 billion, less than 10 years later. That's being worked down gradually. Some of it's been worked down by investing in ethanol plants, right? Some of it's been worked down by chasing social media hotshots over and beyond even the into the realm of irrational exuberance. But there's a lot of venture. There's a lot of venture capital around. The returns on venture capital have been and will continue to be depressed because, obviously, the dirty secret that all venture capitalists know in their hearts is that their returns are intimately coupled with the returns from the public equity market. Venture capital is not a separate asset class, and in particular, to access to the public markets through a reasonably hot IPO market. Absent that, even with the occasional spectacular sale of a private company, and what we see is, in effect, survivor's bias. Returns, I think if I can tell you the numbers, if you think of cash-on-cash returns, so you're not worrying about the ways of playing IRR, from 1980 through 1995, members of the NVCA gave back to their limited partners a little more than 3 times the amount of money they took from them. The 1995 vintage gave back 6 times. The 1996 vintage gave back 5 times. 95, 96, and 90, yeah, 95, 96. Since then, in no year, no vintage has given back more than 1.5 times, and the median venture fund has not given back capital. The skew in the returns continues to be enormous in bad markets as in good markets. Way under 10% of all the venture capital firms generate more than all of the excess return that you would get from just investing in the NASDAQ index. So trying to sell venture capital as a category and as an industry, particularly through a political process, very challenging, very challenging. My message to all the fiduciaries I know is that if you're offered the opportunity to invest with one of the very small number of persistently successful members of that top decile, give them the money. Mm-hmm. Otherwise, do not make an allocation to venture capital.
Yeah. And we're running out of time. I want to give Bob his chance.
Okay. I want to share your optimism about this stopping the effort to delegitimize government. But I'm worried in the opposite direction, which is that there's been a significant effort by the current administration to delegitimize venture capital and private equity and entrepreneurship. I mean, maybe I'm just political because of the opponent Romney, but it's dismaying to see that we didn't build that kind of stuff coming out of the administration.
I just wrote an op-ed piece called "Who Built That?" which talks about the platform that I was dancing on. So I think there's a collaborative process. Look, there was, compared with birther Islamism, I think the Obama campaign was relatively moderate. There were a couple of wisecrack remarks around Romney, and there certainly was, and I do think that there is a distinction made. I think there was a distinction made, and I'm not here to defend the Obama campaign. I think there was a distinction made between private equity and venture capital. I do think that there can be, that there's a huge opening now. And as I said, I think that they really got the clean tech, green tech, that the Department of Energy loan guarantees program should have been strangled at birth. Strangled at birth. But I think they now have an opening, and they hope, trust, and believe they will seize it. I have no idea whether they will. I don't think you have to worry too much in this country, of all countries, about a culture of disdain for entrepreneurship. I don't think you have to worry about that.
So probably, I know we've got 2 more questions, but I'm conscious of the time. You're going to be able to stick around for a little while, right, Bill?
Yeah, I will.
All right, if you guys don't mind just coming up and talking to Bill, let's give him a big round of applause.